Hello, everyone, and welcome to Smartkarma Corporate Webinar. I am Vidhi Bhatt from the Corporate Solutions team at Smartkarma. We are very happy to have with us Trendlines Group's Chairman, CEO, and co-founder, Steve Rhodes, with us today.
Hi, everyone, and good afternoon. Thank you, Vidhi.
We will be starting this webinar with Steve walking us through a company presentation, after which he will engage in a fireside conversation with Smartkarma Insight Provider, Taneja.
Hello, everybody. Thanks.
Great.
Nice to meet you.
We will be taking live question and answers from our audience. So please feel free to post your questions in the Q&A tab at the bottom of your screen. During this webinar, I will also be sharing links with you all to connect with Trendlines Group as well as with Samir. So keep a lookout for messages in your chat box. With this, I will hand it over to Steve to take us through a short company presentation. Over to you, Steve.
Thanks, Vidhi. I'm really happy to be here, and I'm happy to have the opportunity to talk about the Trendlines Group and to introduce you to our unique business model and what we're doing. The Trendlines Group is a company who is out to solve the biggest problems that the world is facing today, having enough food and having good health. And we do that by creating and investing in companies that can address these major global problems. The company is over 14 years old. Today, we have 57 companies in our portfolio, including 20 advanced stage companies that we believe are moving towards significant value building events. We've had 10 exits to date in our portfolio. And on those exits, we're very pleased to announce that we've had an average return of almost 10x and an average weighted average internal rate of return, IRR, of 175%. So we're very pleased with our results to date. And what I'm going to do in the next 9 minutes is tell you a little bit about our business model and the kinds of things that we invest in. One of the most important things that we do at Trendlines is that we're very deeply involved in the companies we invest in. I would say that that's our secret sauce. We're a business development group that creates relationships around the world that can support our portfolio companies. Part of that involves creating strategic partnerships. And I just mentioned here briefly 3 important strategic partnerships that we have. The Consensus Business Group from London is the investment arm of a London financier, Vincent Chengiz. Consensus and its Libra Holdings unit is a major shareholder in Trendlines. They've invested significantly today. They have 23% of the Trendlines Group and have committed to invest additional capital. But at least as importantly, Consensus has invested in more than 20 of our portfolio companies, helping us to build our companies. A second critical partnership that I'd like to mention is B. Braun. B. Braun is the largest privately owned medical device company in the world. B. Braun was the cornerstone investor in our IPO back in 2015, investing $5 million in Trendlines. Today, they own about 3% of the company. But at least as important as that investment is that we have an ongoing relationship with them that gives us access to markets. They've invested in a number of our portfolio companies and even acquired one of our portfolio companies. The last relationship that I'll mention briefly is with the Bayer Corporation, with their Bayer Crop Science subsidiary. We have a $10 million venture fund together with Bayer, and we've invested now in 4 portfolio companies together with Bayer. Like these relationships, we have dozens more with strategic partners around the world, and we create those partnerships in order to support and advance our portfolio companies. And I'd like to, because it's the most important or most interesting part of what we do, is just give you a taste of the kinds of companies that we invest in. Fidalon from our Agrifood portfolio is a company that's creating completely natural food colors through an industrial process without agriculture. It eliminates the need for growing thousands and thousands or millions of acres of crops that get used to produce natural food colors. It solves an enormous problem for the marketplace, for the food industry, while also doing it in a highly sustainable manner. The company just yesterday announced a major strategic collaboration agreement with Ginkgo Bioworks, which is a $6 billion New York Stock Exchange synthetic biology company. And we believe that this company has the potential to really change the way the food industry, the food industry and other industries provide colors for their products. On the medical side, I'll just briefly mention Vensica. This is a medical device company that has a unique technology for treating overactive bladder that combines a device with the use of neurotoxin to calm the bladder without the use of injections. Today, the solution involves injections in the bladder, and we completely eliminate those injections. The company recently completed a $19 million investment round. The round was led by Merz, which is a large German pharmaceutical company, and Laborie, one of the leading urology companies in the world, as well as by IBF, a leading Israeli VC. This is a company that we think will be really a huge company, given that it's a drug device combination company. The last company I want to mention is Orthospin. This is a company that we sold in November of last year, just 4 months ago, to Johnson & Johnson. It's an orthopedics company. Our return on investment here was around 12x. We had an IRR of 165% on this investment, or on the investment from the return. And of course, we're very pleased that the buyer was Johnson & Johnson, another of our important strategic partnerships. We're deeply involved in our companies through our strategic partnership activity. We bring the partners, we help them raise capital, and we help the companies achieve exits. Because of our deep involvement and because the portfolio is constantly growing and progressing, we've seen tremendous growth in the portfolio and its value over the last 15 years. In fact, excluding contingent earnouts that we might earn in the future, and not including 13 consolidated companies, you can see that in the last 5 years alone, our portfolio value together with our exit proceeds has more than doubled, and we're very proud of these results. And that's really what is about in terms of creating value for our shareholders. I'll briefly conclude by talking about our 2021 results. We had a net profit last year of $6 million compared to a $4 million loss the year before. Our total portfolio value was $83 million, basically unchanged from a year before. But you have to remember that during the year, we sold an asset for almost $16 million. So that asset came out of our portfolio value. So in reality, the portfolio value increased over the existing or the remaining companies. Total equity increased to over $102 million US dollars. By the way, all of these numbers are in US dollars. And perhaps most interesting for investors who are looking for an opportunity, our NAV per share is currently about 17 Singapore cents per share. Our share price, I think today, is at around 10.5 cents per share. So we're trading at about a 40% discount to NAV. And I think that represents an opportunity or potential opportunity for investors. This is the company in a nutshell, and I'd be very, very happy to take questions. Samir?
Hi, great. So it's an honor to speak with you, Steve. And now that the introductions are out of the way, I'll probably just get into it straight away. And so, you've got an extremely pedigreed list of shareholders, starting with Zeb Bronfield, who owns 9% of your company. And then I guess Winston Cengiz came on later through Libre Holdings to have about 23% in your company. Then B. Braun, they own about 3% in your company. So maybe if you could walk us through the story behind how these investors, these pedigreed investors got on board and they sort of co-invest and collaborate with you now. That would be a good start.
Okay, great. As I said, at core, we're a business development organization, even though we are technology investors. And the reason for that is because more often than not, young companies, from our experience, don't fail because of poor technology or lack of market need. They fail because of poor execution on the business side. So we've put a big emphasis on our ability to assist companies in reaching out to strategic partners and to the marketplace and to investors to achieve their goals. We have a large number of people on staff who are involved in reaching out and creating those relationships. And I think that's really critical. So the relationships that you talk about, that you mentioned, are just prime examples of those kinds of relationships. Zev Bronfeld is one of the leading early stage investors in Israel. And we partnered up with Zev back in 2007 when we created the Trendlines Group, because we recognized the tremendous value that he could bring from his experience, from his contacts, from his capital markets experience that he could bring to our portfolio companies. And in fact, that's proven to be an outstanding relationship and partnership over the last 14 and a half years. Vincent Chengiz, whom you mentioned, invested in Trendlines about 2.5 years ago. Vincent is a London financier who is one of the most active investors in the world in technology. Vincent has invested or committed to invest more than $50 million with us and with our portfolio companies in the last 2.5 years. It's just a critical relationship because it provides tremendous value to our portfolio companies who are always out raising capital. So having access to someone like that reduces dramatically the risk for our companies, and of course, by extension, reduces the risk for us. Our biggest risk in our business is that our portfolio companies will run out of capital. So we're constantly out. We're going to conferences in normal times, that is, of course. We go to conferences. We take lots of meetings. We get introduced through our relationships. In fact, as I'm sure you know, a lot of business development is about networking. And the introduction to Vincent was made by Zev. So it just proves the importance of having these great relationships. Zev Bronfeld joined us. He's been a tremendous supporter, and he introduced us to Vincent Chengiz, who has then proven to be a major asset for us. Similarly, B. Brown, a company we've known a long time. We showed them our portfolio companies. They fell in love with what we were doing. Ultimately, they bought one of our companies and then have invested in a number of additional companies and also in our incubator in Singapore. So one customer brings another. We get out to conferences, we meet, and it's a process, obviously, but it's a very important process.
That's very comprehensive and elaborate. So essentially what you have is a symbiotic relationship with your shareholders, where logically, of course, they've invested in you and they also invest alongside you. And so maybe, for the benefit of listeners, besides sort of bringing in the capital, and could you elaborate on sort of what value you guys bring to the table to each other besides just the capital per se, just with regards to your investments?
Yeah, of course. We provide an incredibly deep package of support services to our portfolio companies, and I think it's probably unparalleled by anyone in the world. For starters, our companies for their first 2 or 3 years typically sit in our offices, and we provide all of the overhead supports that a young company needs. Not only the office, but all of the administrative support, the bookkeeping, the accounting, the legal services. On the one hand, that reduces their need to go out and look for those services. And on the other hand, it increases the quality of the services the companies give, and it increases our ability, our oversight ability. We see the companies on a daily basis, and we know exactly what's going on in their first 2 or 3 years. But beyond those administrative services, we also have a large team of people who are providing professional services to the companies, like market research, marketing communications, business development, which I've already mentioned, financial consulting, human resources consulting, technology consulting through a team of technologists, and ultimately, I would say investment banking, although we don't charge for that today, but we like to say we are Israel's largest uncompensated investment bank, raising a lot of capital for our portfolio companies. So we really surround them. On top of all of that, of course, we're active members of their boards of directors, providing a lot of strategic support, insight, consulting, and just deeply involved in the companies.
Understood. Wow. Okay. So 57 companies, massive portfolio. Just wonder, without you giving away your secret sauce, really, just want to understand your process. And so maybe if you could break it down, I'll try to make it easier for everyone to understand how we go about this. Is 5 steps. Maybe I'll just sort of try to understand firstly how you shortlist and select your companies that you invest in.
Sure. I don't think, Samir, that there are any great secrets to it. I mean, we start with a team of people who are extremely experienced in the industry sectors. And I mean, our team of people who are doing our deal flow and due diligence. So the folks who are looking at new opportunities have tremendous amount of experience. And that, of course, will always make the process better. We see a lot of opportunities every year, in excess, I would say, of 600 opportunities a year. At most, we invest in 6 to 8 companies a year. So we're only looking at investing about 1% of the opportunities we see. Clearly, when you see that many opportunities and then make such a small number of investments, you're working in a funnel. You whittle down. It's pretty obvious when you're looking at 600 companies that many of them don't meet the minimum criteria or are too early or too late. But ultimately, what happens is that we get into a deep process of looking at the technology, at the IP, but even more important than the technology and the IP, we look at the market and the need. We're very much market driven. We want to understand if there's a need for the product, who's going to pay for the product, how it's going to get into the market, what the barriers are to entry, who the competitors are, and also who the potential acquirers are. So we do a really deep dive into the market and how the product is going to fit into the market. And I would say probably the last thing and the most important thing is we look at the people. We've found over the years that you're better off with great people and a less great idea than with a great idea and difficult people. And especially because our business model is to be so deeply involved, the folks that we invest in are sitting in our offices for their first 2 or 3 years. It's really important that we invest in people who play well with others, who are open to support and know how to accept it and are willing to talk openly about issues, problems. And we really want to make sure that there's good chemistry between us and the people we invest in. Because of that, I would say the entire process typically takes around 8 months, which is a very long time in this business. But it gives us a real opportunity to get to know the entrepreneurs, to work with them together, developing an initial business plan, a budget, and to see how that cooperation works out and to make sure that we really like working with one another. It drives entrepreneurs crazy, by the way, because they want to get started right away if they have fire in their bellies, as we say. But it gives us a good chance to really do a good job of picking the right companies.
Right. And which phase do you typically invest in for your companies? Which phase do you sort of come in?
For the most part, we are actually the first money going into a company. We invest at the company formation stage. In fact, there usually isn't even a company yet when we start talking to the entrepreneur. The first thing we will do after we make the investment decision is get the lawyers to incorporate and create the company. So it's very, very early stage. That's one of the things that enables us to have the high returns that we have on our exits, because we get a big stake in the companies. We invest at very low valuations. We do now have a venture fund based in Singapore that's been making later stage investments. But that's the exception rather than the rule. Most of our companies are very early.
Right. And so do you start out with the knowledge of what sort of IRRs? I mean, you have like such tremendous IRRs, but do you start out with a sort of goal on what sort of IRRs you hope to achieve? And if so, what are they typically? And are there, I mean, you mentioned a lot about people. So are there other intangible and softer criteria you also look at when investing in your companies?
In terms of the kinds of IRRs we're looking for, I would say that when we make a new investment, we're hoping to get at least a 10x return on our investment over time. The IRR is more difficult just because since we come in so early, the time to exit can be very long, and we don't always know exactly when the exit will occur. But as you've noted, we have had 175% IRR across the 10 exits we've had, and we're very pleased with that. Certainly, the 10x return is something that we do look for in our exits, and I think that we should be able to maintain that because, as I said, we come in quite early and get at very low valuations, get big stake in the companies. In terms of intangibles, that's a tough question. Certainly, the people is the most important thing. I guess there is something about when you look at a company, you want to understand whether the area is going to be of interest to the marketplace, not just in terms of market demand, but is the product, and I'll use a term, but I'll use the term sexy. Is it sexy in the sense that it's going to attract investors? It's going to attract strategic partners. You know, there are some products that are great products, but they're very run of the mill, and they don't attract attention. They're not photogenic in the sense that investors look at it and say, wow, this is really exciting. We like to see that excitement factor in the companies we invest in, because there's a lot of competition today for capital, and we go out and we need to raise follow-on capital for our portfolio companies. So we look for that, I would say, that photogenicity.
Interesting. And can I ask, so your investment team, how big is your investment team? And so just sort of like, just trying to understand and assess what sort of workload, because like you mentioned that there were like 600 opportunities you look at. So how big is your team, and you know, who typically are the important people? And are you also involved, like you're also, I suppose, you're deeply involved in the process, but like just sort of, you could walk us through that.
Sure. We have 4 people on staff who work full-time looking at deal flow. So they're the first line of defense looking at those 600 opportunities. But they're supported by analysts. They're supported by our CTO, who helps with the technology and diligence. Certainly our management, our upper management gets involved. The managers of the different investment units will get involved. We won't make any investment until the managers themselves have met many times with the potential investee and are satisfied with the results. So although there are 4 people directly involved on a full-time basis, many of us get involved at different stages in the diligence and investment process.
You were mentioning analysts as well. How many analysts would you be having approximately?
I think there are four perhaps, something like that, 4
okay,
who are helping with the process.
Okay, wow, it's a lot on their plate. You know, 8 guys and 600 companies, so like 80 companies a person. So that's a lot. Like given like there are 52 weeks in a year, so like everyone's kind of really working hard there, right?
Folks here do work hard. It's true.
Understood. So On the topic of exits, once you've sort of gotten in your companies, like what do you broadly look at when you're exiting your companies? You've had 10 exits so far. You've talked about a 10x target. So once you've reached your target, is it about exiting then, or like do you assign a time frame and everything's a sort of moving target? Like, how do we think about that?
Yeah, unfortunately, we have a saying: companies aren't sold, they're bought.
Right.
And what I mean by that is that we only have a very limited amount of say as to the timing of the exit, because you really have to find the willing buyers. We can't just go out and put the company up for sale and expect someone to buy it because we've offered it for sale. So we have to look at each situation individually, each company on a case-by-case basis. In some cases, we can sell companies when they're pre-revenue. If a particular technology is of great interest to one or more potential buyers, if for market reasons they feel like they need to own the patents and need to own the technology for competitive reasons, then we can sell companies pre-revenue, and we're happy to do that. But in many cases, potential buyers want to see some market traction. So that forces us to go out into the market and to begin selling product. As we start selling product, then the next question becomes, how much sales do we need in order to attract a buyer? For some products, you don't need a lot. It's enough for potential acquirers to see that key opinion leaders, for example, on the medical side, are using the product and like it. If you can get major hospitals to buy a product and to use it and to reuse it and to endorse it, and you have the clinical studies to support the product, then in many cases, the big buyers will be willing to come and buy it, even though the sales themselves, the numbers aren't high, but the reference customers are saying, yeah, this is a really great thing. In other cases, the potential buyers want to see some traction in the market and some uptake, and they want to see you starting to accelerate sales. So it really varies greatly from one company to another. We've sold companies from the fastest exit we had was a company that was only 8 months old, where clearly the buyer just wanted the IP, to companies that have been in the market selling and growing, and the acquirers wanted the asset, and they also wanted the sales network that had been built out.
Understood. Okay. And so when we look at your assets on your balance sheet, it's largely, of course, weighted on the basis of the investments that you have, right? And so you mentioned, I was looking at those figures, very impressive. So you have like 83 million portfolio, and I guess it would have been even higher if you had not exited your past in your auto spin. So it's about 97 or something like that. So on that, how typically do we look at the valuation of these assets? Is that done on the basis of what the last raise was, or are there audits? Like how would this happen?
That's a really important question. The valuations are done by an independent third-party evaluation firm. They use a number of methodologies, although the most common methodology is simply the last money in, exactly as you said, looking at the last investment round. What they don't do is they don't take into consideration when they look at the valuation, they don't take into consideration value building events. A company raises money today at a certain value and then takes that money and you hope converts it into increased value over a period of time. A medical company will do clinical trials, they'll get FDA clearance or CE clearance. Those are all events that essentially increase the value of the company, but that value isn't reflected at all in our financial statements. So after the independent financial firm evaluates the companies, those valuations are then audited by Ernst & Young, before we can put them into our books. So there's a check on the valuations and on the methodology. So it's a very rigorous process. All of our portfolio is revalued at least once a year. What's interesting is that when we've had exits, the average exit value has been 4 times greater than the value on our books on the eve of the exit, which gives you an idea of the big gap between the valuations that are being done by the valuation firm and what a willing buyer is really willing to pay for those companies.
Right, understood. And so, yeah, I saw that slide, very impressive slide, 10 million to 44 million, so 4.4 or whatever. So on that, once you get the exit, I suppose you probably recycle your capital almost immediately into other investments, right? And
Correct.
So sort of what sort of time frame do you typically give yourself on these things? Or is it like, because, I guess there's so much churn and you're looking at things, there are 600 things in a year. So 600 potential investments in a year. So is there some sort of like timeline on that? Or do you you're happy to sort of sit and wait it out and have that capital on your balance sheet in case opportunities arise?
Well, that's a really good question. We don't want to be sitting on cash on the one hand, because we feel like we can earn a lot more money in deploying the cash into companies than sitting on it in the bank. On the other hand, we also have to make sure that we have adequate cash flow at all times, particularly since our revenue stream is unpredictable, and that's one of the challenges of our business model. So we always look to maintain at least 3 years of cash on hand. And that's the target that we have, and that enables us, because it's really inconceivable to us that we would go a 3-year period without an exit, given the size of our portfolio, given the stages of our portfolio companies. So we try to maintain at least 3 years of capital on hand. The other thing that we've found historically is that the more capital we have, the stronger our business model is. And that relates to our ability to make follow-on investments in our portfolio companies. Our companies, as I said, we invest in them very early when the valuations are low. And typically their first follow-on round will still be at a very low valuation. And if we have the capital on hand to participate in that round, we can protect our position or even increase it while the valuation is still low, which will ultimately have a big impact on our return on investment.
Understood. And so when we talk about 3 years of cash on hand, how do we define this in absolute terms? 3 years is it's an interesting way of putting things, but I know you have a growing team and stuff like that. So how would you typically in this present day define 3 years?
Well, we're constantly reviewing and update our cash flow projections. Right. We are constantly looking at our staffing levels to make sure that they're the right levels, and we balance all of those things. It's a balancing act more than anything else, to make sure that we have the sufficient capital to invest. Right. To support, on the one hand, and on the other hand, to support our portfolio companies and our activities. You remember that a lot of the, I spoke before about all of the support that we give our portfolio companies, the investment banking, the business development, the market research, and all of those things we're paying for. On the one hand, they show up on our financial statements as an expense, but on the other hand, they really are an investment in kind. We're doing them because we think it increases the likelihood of the companies succeeding and getting to exits and bigger exits. So if we spend an extra $1 million a year on business development, all we have to do is see that the exits we have is a few $1 million higher to justify those expenses.
Right, understood. Okay, so in reality, it's actually just a moving target. Am I correct in assuming that? Because the more investments you have, then that number could change.
Right. That's
understood.
Right. That's right.
Got it. Okay. As a future potential investor, what would be the KPIs you would sort of point investors to look at so as to measure your company? Because, traditional investment styles, where you look at dividend yields and you look at cash flows, those kind of go out of the window when we're looking at a company like yours, which is investing in, new companies that are growing really fast. So what are the KPIs that potential investors should look at for your company?
That's a great question. We talk a lot about portfolio value. We think that that's, even though we believe that the methodology undervalues our portfolio, since the methodology is consistent from one period to the next, you at least have the ability to track the changes in the portfolio. So we think that watching a portfolio value is an important indicator of how we're doing at our mission. We want to see the portfolio value obviously growing. And as it grows, that indicates that we're doing the right thing. So that's an important indicator. Something that I think most people miss, but I think is really important to understand the status of us and our companies, is the amount of follow-on capital that our companies are raising, the number of raises that have occurred, and the size of those raises. And I say that because at the end of the day, we start with companies that are very small, and our goal is to build them up into very big companies. When those companies are young, they're doing small raises of $1 million or $2 million, and that's critical for them to get to an inflection point and to raise their value. But as they get bigger and do bigger and bigger raises, it indicates that the companies have matured or are in the process of maturing and getting to a higher level. So for example, in 2021, our portfolio companies raised a total of $77 million in follow-on capital. That was a record compared to 2020. 2020 was also a record year. We raised $43 million in follow-on capital. Significantly in 2020, two of our companies raised more than $4 million. That was the first time we ever had two companies in a single year raise more than $4 million, which showed that the companies were getting bigger raises. But in 2021, we had 6 companies raise more than $4 million. So I believe it's a really important indicator, not only about the progress, but about the number of companies that are progressing and where they are relative to future inflection points and value creating events. Obviously, looking at the exits is important in terms of looking at the ROI on those exits and the rate of return on the exits, and trying to extrapolate forward what that would mean. Up until now, we had a large exit in 2020. We had a large exit in 2021. Out of a portfolio of 57 companies, we expect to see additional exits in the future. If in a single year you didn't have one large exit, but you had 2 or 3 or 4, it would make a huge difference to a company like us, given our financial structure. So looking at the exits is important. And I think finally, of course, looking at our NAV, both absolute and our NAV per share, are important things for investors to look at.
Okay, got it. No, this is really comprehensive. So to summarize, the most important thing for you is portfolio value. And then, of course,
absolutely,
you look at how much you can raise in terms of capital, how many exits you've had, and the number of raises and the size of your exits. Now, the last 3, I guess, the first, of course, is something that, is obviously something I would say execution related as well. But the last 3, are they a function of the macro environment? Or would you say that there are some other aspects at play which result in these metrics improving or being better or worse for you in a year?
Certainly, some of the metrics are affected by macroeconomics. Our share price, for example, if the markets crash because of a crisis in Ukraine, we don't have any control over that. Or if the markets go down because of a pandemic that hits the world. When in March 2020, when the world markets went down because of fear about COVID, our shares went down along with everyone else.
Right.
But aside from those kinds of influences on our share price, I would say that we are largely not affected by macroeconomic factors. The companies that we create and build have products that the world needs and that the big companies need, and that's going to always be the case. I think the appetite for acquisitions is always going to be there. Now, it's true that during economic downturns, they talk about how big companies are less acquisitive, but the kinds of acquisitions they're talking about is when Johnson & Johnson, which is a $100 billion company, goes out and makes a $3 billion acquisition. Our acquisitions are not $3 billion or $5 billion acquisitions. They're tens or hundreds of millions of dollars. So they really are the kinds of products that don't, I think, get affected significantly by macro events. And because of that, I think we can continue to see growth in our portfolio. There are times when we're concerned about our ability to raise follow-on capital. Macro events could affect follow-on capital availability, although historically we've found that we've largely been able to raise through all different parts of the economic cycle. When there's a lot of money around, investors want to invest in private companies. When markets go down, when the public markets go down, investors don't want to have their money in the stock market, and so they may put it into private companies that are longer term investments. We haven't really felt a big impact from market fluctuations on our business.
Understood. When we were talking about KPIs, another thing that came to my mind was like, do you have some sort of success ratio that you look at? A success rate, and sort of if like let's say there are certain situations where some investments of yours aren't really working out the way you want. How do you step away from those companies?
Oh, that's a great question, and it's an important one. Not everything we do works. That's for sure. We've written off about a third of the companies that we've started. And those write-offs happen for a lot of reasons. We review the portfolio on a monthly basis to decide whether we're reviewing it for a lot of things: what help the companies need, what their status is, are they exit ready, what should we be doing to improve their performance. But one of the important questions we ask is it time for us to step away from this company? Do we still believe in the company? Do we still want to continue supporting it, or have we lost faith in it? We sometimes step away from a company, and even though it continues to operate, just because we've lost faith or belief in the company. Sometimes the companies fail because they can't raise capital or because they have technology problems, although that doesn't happen very often. But it's a process that we do on a regular basis. And when we do write off a company, we always conduct a post-mortem process where we get everyone who was involved in that company to try to understand what mistakes we made, if any, along the way, and what we could have done better. Did we make a mistake investing in the company? Was it a wrong investment? And if so, what happened, and what questions didn't we ask? If it was a good investment, but something went wrong along the way, what were the warning signs that we missed, or were the things we could have done to improve the outcomes? Because we really want to learn from our mistakes and try to avoid them in the future.
Understood. So on capital, of course, growth requires capital, right? And you're in the process of raising more capital. Is that yeah? So maybe if you could elaborate to people, like of course, of the capital that you're raising now, and also how you what, again, we've talked about how you intend to employ your capital, but maybe just sort of the benefits of, and like maybe if to the extent that you could actually potentially how this would like sort of help you, and if the investors are repeat investors or some people who've had
Sure.
faith in your process or something like that.
Sure. We are, as you said, in the process of raising additional capital through a private investment. We have 4 sophisticated investors who are coming in, actually investing at a premium to the current market price. As I said before, the more capital we have, we believe the stronger our business model and the more we can take advantage of the opportunities we have. We sold a company called AFIC just about 2 years ago, and we did an analysis of that company because AFIC was a company that had raised capital 3 or 4 times prior to their exit. And what we found was that 2 of the capital raises were at valuations of below $10 million. Towards the end, as the company got closer to exit, the valuation went up. But the company had 2 early investment rounds with very low valuations. And if we had participated, if we had invested about another $1 million when the valuations were still under $10 million, we would have earned another $10 million in the exit. So essentially, we left $10 million on the table because we didn't have sufficient capital to invest in the company. So we believe it's really important to have that capital to invest in the follow-on rounds of our companies, to support them, and to get bigger pieces or to protect our pieces when the valuations are low. As I mentioned before, we want to try to maintain 3 years of capital on hand. So we look at the needs of our investment desire, how much cash we want to be investing in those companies. We look at the capital needs of the company, and we reach decisions about raising additional external capital. We would always prefer to raise that additional capital at a higher than market price, or to see the share price going up and do it in the marketplace. But it's a decision that we have to make in order to be able to support the model.
Understood. All right, last question for me. I wanted to understand, what the vision and the goal of the company is to be within the next 5 to 10 years.
I think the vision is to have lots of exits, to really create value for our shareholders in a big way. We have this very rich portfolio of companies, and we need to really work hard to convert the 57 companies in our portfolio into value for our shareholders. And I think that that's really the focus in the coming few years, is working that existing portfolio to throw off a lot of cash, to share that cash with our shareholders, and I hope also as a result to get some more appreciation from the capital markets.
Sounds very good, Steve. Thank you so much. I'm going to hand it back to Vidhi, and yeah.
So, Samir, thanks very much. This was great.
No, great. Thanks. It's an honor, Steve. Thank you so much.
Thank you so much, Samir. We almost lost track of time because it was such an interesting conversation, and you had raised some really interesting questions for Steve to answer today. I would also like to thank you, Steve, for giving us a detailed insight into Trendlines Group, how you manage the portfolio, how you handpick the strategic investments at the company. Thank you so much for that. I would also like to thank our attendees who were able to join us live today. Thank you so much, and for your questions as well. With this, we would like to wrap up today's session. Thank you so much for joining. Thank you, everyone, and we will see you again next week.
Thanks very much.
Thanks. All right. Cheers.
Thank you.
All right, see you. Bye-bye.